Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for the segment, we have Scott Nations, president of Nations Indexes, to discuss the Nasdaq-100 Volatility Index, known as VolQ, as it hits a new 52-week low today. Scott, it's great to see you as always. Welcome back to Trade Talks. And you and I have discussed this as VolQ sort of sits near lows if traders are too complacent or if they're just not as worried about the macro backdrop as some of the other indexes might suggest.
It's a great question. It's really the question that matters. VolQ right now about 1726, as you pointed out. That's a new 52-week low today, and that's to be expected, Jill, because we're past most of the important news. So we've just come out of an earnings season, which was pretty good, and we've just gotten all of the relevant or most of the relevant inflation data. We got that last week. And that was all slightly better than expected. And those are the two things that people are really paying attention to right now. So if the news is passed and it's better than expected, then you would expect implied volatility as measured by VolQ to come in a little bit. Really, the only fly in the ointment, if you will, is all of the concern about the debt ceiling. And that is perfectly reasonable. I don't think that we're going to end up having a problem. In fact, I got to spend a little time alone with my congressman this weekend, Mike Quigley, 5th District of Illinois, and I asked him specifically about it. He had two things to say. He said, one is the first thing was a little concerning. He did say that there have never been this many variables at work in a debt ceiling conversation, but he did say the only thing you can hope for is that everybody shows up and they're rational. And I think at the end of the day, everyone who's a decision maker, a policy maker is going to end up being rational, because it would be horrible for the economy and the stock market if we had some sort of default.
Right. Well, of course, I mean, not only for the economy and the stock market, but people who are reliant on these payments for month to month, while they're politically posturing, all these things kind of do matter. But I want to go back to the Nasdaq-100 for a moment, up 22% on the year. How concerned are you that a lot of the movement has been concentrated in just a handful of names?
That is the concern. And you're right. It's up just over 22% year to date. And that ignores dividends. Now, dividends not a big part of the Nasdaq-100 index, but it's up just over 22%. That's about triple any of the other important indexes. So that's about triple what the S&P is up on the year. And much of the increase in the Nasdaq-100 has come from the biggest names. And if you look at the four biggest names, so that would be Amazon, Google, Microsoft, and Apple, right now they account for 20%, fully 1/5 of the S&P 500, just those four names. And we know that that sort of concentration, that sort of overweight is not particularly good. Why? Because it leaves the market vulnerable. In the case of a sell-off, people are going to want to sell the biggest, most liquid names. They're going to think that they can get best sort of execution. And so we'll see those names, the biggest names, really impacted disproportionately if we do have some sort of sell-off.
Right. But back to your point earlier with earnings, it seems as if these companies have adopted their operational environments to what we're seeing with the macro. There was really no crazy surprises in there.
No, I think they've all done a good job of, and I don't mean to disparage them, of managing earnings. They've done a good job of cutting expenses, maintaining revenue. They've done a good job in a relatively inflationary environment. They've also done a wonderful job of explaining to the market what they expect. And then, while I'm not saying that they underpromise, but they do over-deliver slightly. And so I think that there are lots of reasons to think that they've done a good job in that regard. Also, Jill, there's another reason why VolQ and implied volatility in general is coming in a little bit, and that's the calendar. Implied volatility tends to be lower during the summer when people are taking time off. So the fact that VolQ is making a 52-week low in the middle of May is not that much of a galloping shock.
All right, Scott, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.